Discuss what a closed-end fund or a closed-end investment company is. So just to take it a step back, the Investment Company Act of 1940 created three different kind of investment companies: face amount certificate, unit investment trust, and management companies. Management companies broke down into open-end funds and closed-end funds, right? So what's the main differentiation point? Open-end funds are open to new investor. Closed-end funds are closed to new investors. So it's almost like a stock where it has an IPO once, maybe it has an APO slash SPO slash follow-on in the future, right? But it's only going to raise money once, right? What makes the biggest differentiation point between a closed-end fund and an open-end fund? And now when I'm comparing closed and open-end funds, I'm assuming that I'm comparing mutual funds because nowadays ETFs are considered open-end funds as well. So I'm just comparing mutual funds and closed-end funds. So a closed-end funds, it trades like a stock. So you can basically get in and out anytime you want, right? You can also buy it on margin. You can short it. Another interesting fact is the fact that closed-end funds can issue bonds and preferred stock. Open mutual funds cannot. Mutual funds can only issue equities. So basically common stock, essentially. And there's actually a good reason why. Because mutual funds, since they're open to new investors, what's the purpose of issuing bonds and preferred stock? The reason closed-end funds have that ability is because they can't raise money continuously by offering more and more shares. So they have to, they basically have to sell once or twice, and then and that's it, and then basically trade on the exchange. So they can also trade at a discount or premium to NAV. Net asset value is assets minus liabilities divided by number of shares. So if you think about a closed-end fund or mutual fund, they do own other securities, right? That's the whole purpose. They're like a pooled fund. So there's a pool of a bunch of different securities. So you might have some Apple in there, some Nvidia, some Tesla, Ford, whatever, right? You have that all together. So there's going to be that value for like a mutual fund is going to be based on the inherent value of the security. So like how much is Apple trading for? How much is JP Morgan trading for? How much is Ford trading for? So you're going to add all those together and you're going to buy into the fund at NAV plus a sales charge if it's a mutual fund. With a closed-end fund, you're going to buy at whatever market price. So you're going to pay a market price plus a commission, unless you have like a free brokerage where you're just going to pay the price of the shares, right? So again, you can short it, you can buy it on margin, all that good stuff. And you might ask, why does someone use an open-end versus a closed-end fund structure? So for example, could be a couple reasons, right? If you think you're going to raise an unlimited amount of money, you're probably the best bet is using a mutual fund, right? Because you're going to be severely limited with a closed-end fund. Now, with a closed-end fund, one big benefit is the fact that you don't have to worry about daily liquidity. In the sense, like, it's actually, the funny thing is it's more liquid than a mutual fund, but at the same time, from the manager's perspective, they don't have to worry about the liquidity, right? Because that liquidity is provided by other owners of the shares. So with a closed-end fund, if the manager wants to maybe invest in something that's a little bit more illiquid, right? Maybe like something that's harder to get out of, companies that are like small cap or something like that, where their spreads are big, et cetera, that might not be a bad idea to use a closed-end fund structure so you don't have to worry about being able to get out at a moment's notice. I mean, pretty much if you're a mutual fund, you have to get out the next day or the same day at 4 o'clock, recalculate NAV. So you can get into trouble where, you know, with a mutual fund, if there's a bunch of net redemptions, you might be forced to get out of a position at a disadvantageous number because of the fact that you have to provide liquidity legally to the investors. So closed-end funds don't legally have to calculate their NAV, but oftentimes they will do every day. Those are kind of really the big points of closed-end funds. So they literally look like a stock. I mean, they're sort of like, they kind of remind me of ETFs in a way, except ETFs are considered open-end fund, not closed-end funds, because they have this in-kind share redemption process. But hope you appreciated this knowledge. Please like and subscribe and listen for more. Have a great day.